I'm Sarah Swan, Vice President Portfolio Manager at Howen Wrestling. Today's StreetSmarts is geared towards those of you not earning a traditional paycheck from an employer in which a portion is automatically contributed to a 401k. You are your own boss, so the onus is really on you to get some sort of plan rolling. And the landscape looks a bit different for all of you self-employed individuals. You have a few plan options to choose from, which is great, but that also tends to mean there are lots of nuances to understand, and what feels like guesswork can be too much for people to want to deal with. But lucky for you, that's our job. What I will say before we dive in is that these options are all retirement plans, and they should really be thought of as such. I say that for two reasons. Number one, your goal with one of these plans should be to put away money so that it grows between now and when you're in retirement. And number two, which is a bit more punitive, is that you would have to pay penalties if you wanted to withdraw the funds in these plans before age 59 and a half. But the great flip side is that because there are rules and parameters like that, the IRS allows serious tax benefits, whether in the form of deductions or in the form of tax-deferred growth. So let's get after it. The first option is a really good one. It's the solo or individual 401k. This is basically just what it sounds like. It's a standard 401k where you make contributions from your earnings, pre-tax. But it's specifically only an option for small business owners who don't have any employees. Your spouse, though, doesn't count as an employee. So if by chance your spouse works for you, that doesn't count. Now, this is the incredible part. As the owner of a solo 401k, you're actually allowed to contribute as both parties, the employer and the employee, which means that the contribution limit is among the highest of all retirement plan options. It's essentially as much as $58,000 in 2021. That's $19,500 in your capacity as the employee, plus up to 25% of compensation in your capacity as the employer. Also, depending on the structure of your business, solo 401k contributions that you make should be either deductible from your personal income or eligible to be counted as a business expense. Win-win. Now, like I said early on, if you have employees other than yourself and your spouse, this does disqualify you from doing an individual 401k. So let's move on to some other options, starting with the SEP IRA. A SEP IRA is probably most fitting for those of you with a small number of employees. And I say that because the catch with a SEP IRA is that as the employer, you must contribute an equal percentage of salary for each eligible employee, and that includes yourself. And actually, employees themselves don't contribute at all. It's purely funded by you as the employer. So you sort of have to think about all of your employees in the same way you think about yourself, because whatever percentage you yourself want to put away or contribute, you have to do that same percentage for each of your employees. You're not required to fund it every year, though, so in that sense, you have total control over when you make contributions. So really, you could base it off, say, the business's success or cash flow in a given year every year. The contribution limit mimics that of the solo 401k, so it's possible to fund a SEP IRA with as much as $58,000 annually, like I said before. This could be a really attractive incentive to your employees, and another perk is that all of the contributions you make as the employer are tax deductible. All right, so what if you want your employees to be able to contribute as well so that you're not bearing the burden all yourself as the employer? Then a simple IRA might be a good option. A bit of a misnomer, it's not exactly simple to set up from a paperwork perspective, but here we are. Still totally doable. A simple IRA is a great option for mid-sized companies. The annual contribution limit is $13,500, so not bad. Unlike the SEP IRA, the contribution burden isn't solely on you. Employees can contribute too, but as the employer, you're required to either make matching contributions of up to 3% of employee compensation or fixed contributions of 2% to every employee. The fixed contribution means that even if an employee doesn't contribute on their own behalf, you still have to contribute 2% of their pay, whereas the match means you only have to contribute if the employee does. Once again, contributions are deductible, and the contributions you make to employee accounts can be counted as a business expense. Lastly, I'd be remiss not to mention IRAs and Roth IRAs. They're not employer retirement plans, they're actually individual retirement plans. But they are certainly tax-efficient vehicles that would be solid options for self-employed individuals. So, a couple things to understand first. IRA contributions are tax-deductible and earnings grow tax-deferred, whereas Roth IRA contributions are a little bit the opposite. They're not deductible because they're made with after-tax dollars, but the contributions then do grow tax-free. Basically, there are almost opposite perks to these two scenarios, and your individual circumstances, as you can imagine, very much matter. Maybe you're in a lower tax bracket now than you think you'll be when you withdraw the funds in retirement. Then it might make sense to do a Roth IRA and get the taxes out of the way now. But maybe the opposite is true, and maybe you're a high earner now. Maybe you'll likely drop tax brackets in retirement. Then an IRA could be a nice fit. Regardless of whether you go with an IRA or a Roth IRA, it's important to understand that there is an income phase-out, after which your contributions to an IRA are not tax-deductible, and contributions to a Roth IRA are actually not allowed at all. So, step 1, make sure you have earned income to begin with. Hopefully you do for this entire video. Step 2 is to make sure your AGI, or adjusted gross income, which you can get for your tax return very easily, makes you eligible for an IRA or a Roth. Then understand that unless you're over age 50, the maximum annual contribution is $6,000 and could be slightly less if your income is towards the top of that phase-out range. This is where working with an accountant, in addition to a financial planning professional at How and Wrestling, is pretty critical. Okay, I know it's a lot, but sometimes the biggest hurdle really is just committing to getting started. All of the accounts I've described are quite painless to open on your own, and you can actually do so with most established brokers, even just online. As always, we recommend using Charles Schwab or Fidelity. But again, this is what How and Wrestling is here for, so please don't hesitate to reach out to us. We'll take the guesswork out of it, and you can rest assured you're doing your part to just invest in your tomorrow. Thanks for tuning into StreetSmarts today, and I'll see you next time.